Welcome to another episode of Money Matters. Let's talk about the coronavirus and where we stand with the markets. So it's the beginning of April and it seems as though we really are in the eye of the storm when it comes to dealing with this coronavirus. Nations across the world are declaring national emergencies. They are declaring that people should be enforcing social distancing, they should be working from home, and businesses have shut down across many sectors. It seems we really have a long way to go before we're tackling this virus. Now, here in the East, here in Hong Kong and China, it seems that we really were just about to turn around the corner in getting control and controlling the spread of this virus. But it's rapidly spread to other parts of the world. Only today that the White House was declaring that they are predicting between 100,000 and 240,000 deaths in the US alone. It really is a global pandemic. I think during these times it's really important that the whole world really begins to work together. It's the responsibility for every individual to do their part to fight this virus. We really need to stay in as much as possible, really follow the rules of the governments enforcing social distancing and really not going out unless it's really necessary. The quicker we can control the spread of this virus, the quicker we can return back to normal lives and businesses will be running as usual. I think everything hinges on getting control of this virus as soon as possible. So where do markets stand today? Well, it's pretty bad news all around. Here with the Hang Seng Index, it's fallen circa 25% from the peak to its bottom, one of the worst performances for a long time since the global financial crisis. With the S&P 500, that's fallen 20% this first quarter. That's the biggest drop since the global financial crisis. European stocks down 23%. That's the worst quarter since 2002. It's really just bad news all round. What does this mean for investors? So I want to highlight the fact that when it comes to taking in this news that we're hearing all the time, it's important to get some perspective. Now, I've talked about the disparity between news and market performance. In this case, it's more about when you're receiving this market noise, taking that into perspective when it comes to your own investments. Now, a lot of the news that we hear in the headlines, it's very myopic, it's very short term. It's talking about what's happened perhaps this morning as markets have opened. It's perhaps talking about what's happening this week or today. It's talking about a very short time frame. However, for most investors, when it comes to our own investments, we tend to be investing over a far longer period of time, typically years, so 5 years or even perhaps 10 years or maybe longer. So we have to get some perspective on how we take in this news that we hear in all of the headlines. It may not be as bad as it sounds. Now, there will be a natural delay to when how markets react to the effects of the coronavirus. When we hear about a certain number of cases or a certain number of deaths that a particular nation is seeing, there will be a delayed knock-on effect to the local economy. For example, businesses will take a bit of time before they report loss of earnings. It will take a bit of time before we hear about unemployment rates shooting up. It will take a bit of time before we hear about people claiming social services. So there will be this natural delay till we fully realise how bad the coronavirus has had an effect on the economies. Now, lest we forget, underneath the issue of the coronavirus, we already had underlying issues such as a slowing global economy. Lest we forget the US-Sino trade war that's still lurking in the shadows. I don't think that's resolved right now. So when you compound all of these issues that are affecting the markets, the outlook really does look grim. Governments around the world are announcing stimulus plans for the economy. Only the US recently announced a $2.2 trillion stimulus bill. Hong Kong, Singapore, China have all put in packages to help local businesses and individuals survive this slowdown because of the virus. Now, here in Hong Kong, we know that the government has significant cash reserves to deal with the effects of the slowdown, which is great. Other nations, other governments, not so much. They maybe are already in debt, they maybe are already in a deficit, and forking out for these huge stimulus packages will have an even greater effect on recovering from the effects of this coronavirus. So I think the light at the end of the tunnel is a long way away. But take this into perspective. Does everyone feel that the coronavirus will have permanent damage on the markets, on businesses? To some degree, perhaps. Or do we think that we will overcome this virus and we will eventually, businesses and our lives will return to normal? Well, I hope so, and I also personally believe that things will eventually return to normal. What does that mean for the average investor? Well, it means that there's a huge opportunity to invest right now. Now, of course, a lot of investors will already have the chips down on the table. They're already invested in the markets, and no doubt many of us, including myself, their portfolios have taken a downturn during this period of time. Perfectly normal. Most portfolios will largely follow market performance. With your existing portfolios, unless you're desperately in need of them, don't touch them. Leave it where they are. Remember back to your original objective of this investment. It's unlikely that you were looking to take your money out today, so therefore, why make an emotional knee-jerk reaction and take your money out at the lowest point in the market? When I say the lowest point, I mean roughly at a low point. So leave it in there, remain invested, and believe that markets will eventually recover. Now, I'll make another video on the 3 main factors on why markets generally go up over time through peaks and troughs. They always continue to go up. I'll talk about that in another video. So with that belief that the markets will recover, you simply leave your investments where they are. Maybe review them, but certainly don't take the whole lot out and crystallize the loss you're currently making on paper. Where the opportunity lies is that valuations of companies and assets as a whole are generally very, very low. If we're looking at valuations using the price-earnings ratio versus the mean, a lot of assets are trading well below average. So it's certainly a huge opportunity to buy in. The last such opportunity was during the global financial crisis. How many people took advantage of that period of time? If you did, you would have made huge, huge returns during that period. And I think the same thing is happening here. The losses currently aren't quite as large as what they were during the global financial crisis, but like I said, if we're talking about the Hang Seng Index, that fell circa 25% from its peak to its lowest low. S&P 500 fell roughly 34% from its peak to its low. There may be more bad news to come for maybe Europe and the US in particular. But it means that it's a great time to buy in right now. It's a great time to buy assets at a low, low price. Now, let's set some ground rules. I think for investors, it's important to maintain a decent amount of liquidity during these times. You may be experiencing your expenses being higher than normal. If you're running a business, you may be seeing that revenues are falling. So maintaining a decent level of liquidity throughout this period of time is very, very important. However, if you do have excess cash, it's important to buy in now before the opportunity passes. If you're looking for some form of recovery before you buy, be careful of that sharp V-shaped bounce in the market, in which case you would have missed out on much of the return during this recovery process. You don't necessarily look for that recovery in order to buy in. You buy when things are very, very bad, when there's lots of uncertainty, when market sentiment is at an all-time low, very much against your intuition. That is the time that you buy into the market. Now, I'm not normally one that advocates timing the market, so so you wouldn't necessarily buy in now and then sell once the markets have recovered. You can play that game, but what we're talking about is investing for your long-term future. So that's the approach I tend to take with my clients. We're not trying to buy cheap. Never has buying cheap led to good results. It's a false economy. It's very important to buy quality assets that have a good future ahead, so quality companies that are able to withstand the effects of this downturn in the market and has the potential to make serious recoveries when things return to normal. So it's important to start with quality companies priced fairly, or in this case maybe undervalued, and you're buying them at a really, really cheap price with the expectation that it's going to recover once market sentiment returns to normal. Also, when you're buying into markets, there needs to be a bit of caution and a bit of skill involved. If you're buying broadly across all markets, then timing isn't so much of an issue, because I would say the West and the East are on different cycles. The virus came out of China. I think we can all sort of agree on its origin, shall we say, and that affected China, Hong Kong, Asian nations first, and then it hopped across to Europe, US, and other parts of the world. So what we've already felt here in the East, the West are really feeling it right now. They really are in the eye of the storm. Now, a simple way to view market performance is to just focus on one thing, that's earnings. Earnings meaning profits. If a company is not receiving as much revenue as it had before, its profits will fall, therefore its earnings are falling. If there's an announcement by the company that its earnings have fallen, the market will respond. Its share price will fall, and therefore markets as a whole will come down in value. Now, what we need is to quickly get control of the virus so that people's lives and business can return to normal, so that people are spending their money, businesses are increasing their earnings again, and obviously their share price will recover to a large degree. Therefore, a lot hinges on how quickly we can control this virus and how quickly we can have our lives and businesses return to normal and get those share prices back up again. Now, I won't talk about what you should buy, because by the time you watch this video, it'll be a different time and markets will be in different circumstances. So there's no point talking about what you should buy, how you should make your investment into the markets. And it's different for each person as well. So when I talk to clients about making an investment, each solution is bespoke to their own needs. So I won't talk about that in a video. However, it's important to focus on the factors that we can actually control. Okay, so first and foremost, number one, always create an investment strategy that fits your personal goals and targets an outcome that helps you to achieve your goals. Make it specific to you. Think about what you want from this investment if you're entering the market at this point in time. Number two, diversify to manage the volatility. Yes and no. So you may take a more of a high conviction approach where you're stock picking. You're picking specific companies where you feel have the best chance of growth once we come out of this period of time. However, some other people might prefer a far more broader approach to entering the markets where they're buying a bit of everything. Absolutely fine. It's different for each person. Bear in mind that the more concentrated your portfolio is, the more susceptible to volatility it may be. So having a well-diversified portfolio may manage some of the volatility. Manage your expenses. So like I said, control your expenses. It's important to have a positive cash flow. Try and invest as early as possible, invest as much as possible, and keep your eye on the prize. Keep your eye on the light at the end of the tunnel. Understand the outcome you're trying to achieve by making this investment, by entering the markets right now. You have to stay disciplined throughout market peaks and troughs. So let's say you have an investment, it's down, let's say 20% because of this virus, and you're looking at a valuation, shaking your head, looking worried. Think about your original investment objective. Were you planning to take the money out now? The likely answer is no. So remain disciplined, understand how markets work, and that we are just going through a period of time where markets are at extreme lows. Things will recover, and that portfolio value will increase again. You just have to trust in markets to recover and deliver you returns again. So in summary, remain invested where possible, invest more of your cash now before the opportunity passes, but keep plenty of cash reserves. I would say keep a minimum of 9 months of living expenses, ideally more, particularly during these times. Review the plans which you probably haven't looked at for years. I know many people that have existing policies where there's been no review of its performance, no one's looked at it. Perhaps now is a good time to review these plans. Also, looking at the bigger picture, review your own life goals and your direction that you're headed in. Perhaps you're going for a career change. Perhaps there are some certain changes to your lifestyle that may mean that your investments may need to adapt to your current circumstances. So maybe now's a good time to review your life goal and your general direction you're headed in. Most of all, we really need to work together. Each and every individual must follow the government guidelines. The performance of the markets and how quickly we can recover hinges on how quickly we can control this virus. You know, the more we have businesses shut down, the more working from home or staying at home we have, the greater the effect on the markets. We need to quickly get back to normal, control the spread of this virus so that businesses can reopen and businesses can return to normal, earnings increase again, and markets have a chance to recover as quickly as possible. So we don't need blame games, we don't need conspiracy theories, we don't need fake news. What we do now need is for everyone to follow government guidelines, all work together, follow the social distancing guidelines so that we can quickly defeat and overcome the spread of this virus as quickly as possible. So that's it from this episode of Money Matters. I just wanted to give a quick update on my view on where we stand with the coronavirus. I wish everyone well, everyone to remain safe and stay at home as much as possible, enforce social distancing. Let's try and support each other, our friends, our fellow man on the street. Together we can overcome this difficult time of our lives. So I wish you all well, stay safe, and I'll see you on the next episode of Money Matters.